Hello and welcome everybody. Happy Friday, welcome to the end of another week and another Sectors Made Simple webinar. I'm happy to be here with you all today to cover the next part of our Back to Basics series. We've covered in the past now the basics of point and figure, what the matrix is and how to read it, and today I want to take a look at another part that we offer on the Sectors Made Simple dashboard that's not related to the matrix itself, but is still a very valuable indicator to look at when considering investing in a sector, either as an ETF or just stocks within a specific sector. So today, I want to cover this in detail. We're going to talk about this idea of Bullish Percent Index, what it is, where we can find it, both if you're a Sectors Made Simple subscriber or not, but also the importance of having not just what's out there, but what Sectors Made Simple offers for BPI as well. Also, as we've done for the past few webinars for this Back to Basics series, I want to ask us all a question. What sector are you looking at right now that you hope to see growth in the coming weeks from? It's no surprise that the market has had a very difficult week. If you're watching this recorded, we are currently in the first week of May. Jerome Powell announced and the Federal Reserve announced another increase to the federal funds rate, and the market's response to it has been red. But we hope to see these changes or this trend reverse in the near future. And in anticipation of that, what sector are you looking at to see positive growth from in the coming weeks? We'll get to talk about that more towards the end of today's webinar, but in the meantime, I want to get straight into today's material, which is going to be all about BPI. So let's go really quickly and take a look at the Sectors Made Simple dashboard. If you come to the matrix, you'll be welcomed by the matrix. And on the left side, under Sector ETFs, if you click here, you will find all of the ETF prices, and then below it, New York Stock Exchange Sector BPIs. We've got some X's and O's, which means we're probably going to be dealing with point and figure today. And we have some prices? Not really. Today, you'll learn exactly what these BPI values are, but more importantly, how you can use them. So let's get straight into today's webinar by talking about the basics, BPI. As I mentioned right before, today's question is going to be, what is BPI, and more importantly, how do I use it? As I just showed you, the section we're going to be talking about is this big NYSE sector BPI and what those values tell us. But before we talk about BPI, I first want to review a little bit about point and figure so that if you're just watching this one webinar, you don't need to go watch an entirely different webinar. You can get the basics and the important parts of what you need to know all right here. So what you see right here is not a demonic game of tic-tac-toe. It is a style of charting called point and figure. In point and figure, instead of looking at one line being every day or every period in the market, instead we have columns of X's showing us positive direction over time, and we have columns of O's showing us negative price changes over time. What that ends up doing is, because all we're looking at is trends, positive and negative trends or direction, each line, each up and down line is not one day. Instead, it's a trend, and we can see where these trends start and end based on these different X's and O's. So when we see a column of X's, we know it's going up. When we see a column of O's, we know it's going down. to add on to the current direction, so if we're going in a column of X's up, to add another X on top of our column, all we have to do is have the price go above this little dash. So you see how here it says 152 and that little dash below it? If the price goes above that 152, we would now put another X in that box. For O's, it's slightly different. For example, in this box that we see here, which would be the box for $140, in order for us to go to the box below it, we would need to go below what that box says. So in order to go one more O below, poet didn't even know it, we would need to go below $138. So that is how we continue. One X would be going into the box above, and then one O would be going below the price of that box. Now to switch directions from X's to O's or O's to X's, we need at least 3 boxes in the opposite direction to see that change. So if you notice, starting up here where my cursor is towards the top left of the chart, we have 3 O's, 3 X's. It can never be less than 3, but it can be more. So then we have 4, 5, so on and so forth. 3, back in March, we had 3, 3, in April, 3, and so on. So we will always have a column of at least 3 boxes or larger. And this doesn't say that each column is a day. Each column is just a trend. If it's a positive trend, as long as the price is generally going positive, we will continue that column. When the price reverses 3 boxes or more, then we change from O's to X's or X's to O's. So that's the basics of point and figure. But one of the really valuable things about it, because we're ignoring time, all we care about is price, it gives us very clear buy signals. Now this doesn't mean when you see a point and figure buy signal, go and buy it, it's going to make you millions. This is strictly a chart signal. This is not me telling you to go buy it. This is point and figure basics and charting basics. But it's referred to as buy signals. That's what we're going to refer to it as today. And you'll get the idea of why these signals are valuable. Let's start off with a buy signal. A buy signal is given when our current column of X's, so we have to be in a column of X's, goes above the previous column of X's. So when the price goes up, and then reverses back down, that creates what's called a resistance barrier. It's the point at which the price turned around last time. So now, when we start going up again, when we reach that resistance barrier, this is where things turned around last time. So we want to see what it does. Let me show you an example. We're going to use this chart on the right as our example here. The price starting on the left side goes up to the $166 box and then stops. Reverses back down below $160. So we would get our 3-box reversal, making this middle column of O's. Now, we set our resistance barrier where the X's stopped. Right at that green line. So below the $168 box. Now, our buy signal is given. The point and figure buy signal is reached when the price goes above $168, goes into this X right here, and goes on what's called a breakout. In this case, it's a double top breakout. There are many different types of buy signals. I'm not going to get into them today because frankly, this is the Back to Basics series. This is teaching you the things you need to know to get more out of the matrix. If you're interested to learn more about point and figure buy and sell signals and the different signals that can be given, I highly recommend you go and take a look at our previous webinar or our past webinar where I cover these signals in detail and talk about many of the common signals that you might see. But all we care about, and for even all of those signals, the buy indication is always the same. Current column of X's above the previous column of X's. Setting a resistance barrier, and then breaking that resistance barrier. Everyone with me? Cool. Let's now talk about the other side, the sell signals. A sell signal is the opposite of a buy signal, where a sell signal is given when a column of O's goes below the previous column of O's. Let's again use this example right down here to show this in picture form. Just like we had our resistance barrier for when the price stopped and then turned around, here we have what's called a support barrier. So the resistance barrier is the ceiling, support barrier is the floor. Our sell signal is given when the price falls below the support barrier. To show an example of this, let's use the chart right down here. In the column on the far left, it goes up to $92, then goes down to below $89, which gives us that 3-box reversal. But it doesn't stay there for long. The price rallies and goes back up. And now we get that that support barrier set. So that red line is now our support barrier. It's where we made it to last time, but this time it stopped. Or sorry, we made it there last time and that's where it stopped. So now the price goes back up. And the sell signal is given when the price goes below this box right here. So when the price goes below $88, giving us, instead of a breakout, we now have a breakdown. So that's a little bit of a review of point and figure. So now that we know the basics of what a buy signal is and what a sell signal is, let's now dive into bullish percent and how it uses point and figure to give us a market indicator. Also, if you are curious or if you're still a little iffy on point and figure, our Back to Basics webinar on point and figure is available and will cover what I just talked about in a lot more detail and will answer many of the questions that you might have, as well as why we use point and figure here at Sectors Made Simple. But for today's topic, we're here to talk about BPI. So let's get right into BPI. BPI can be found not for one stock. You can't get a BPI of one stock. Instead, it can be found for any group or subgroups of securities. This could be something like a broad market or an exchange, like the New York Stock Exchange. It could be for an index, such as the S&P 500 or the Russell 2000. Or it can be for sectors, utilities, technology, real estate, or some combination of them. You can find the BPI for utilities of the New York Stock Exchange. You could find it for technology stocks in the S&P 500. So we can play a little bit of mix and match here. But no matter what group you pick, there's always one thing that it always shows. BPI never changes what it means. What it means is it's a percentage. BPI does not give us a price, it gives us a percent between 0 and 100. That percent is the percentage of companies of that group that are on a buy signal. That's the reason we can't have a BPI of one security. If we did, it'd be 100 if it was in a buy signal or 0 if it's in a sell signal, and that's not very useful. Instead, BPI is a percentage between 0 and 100, showing us how many companies in that group are on a buy signal, again shown as a percentage. Because this percent changes, where if more companies go on buy signals, the percent goes up, and if companies start going on sell signals, that percent goes down, we can track these changes in BPI over time. To keep things consistent, we can track them over a point and figure chart. But there's nothing requiring that you use point and figure. To just quickly show, I want to show this really quickly. We'll come back to this website stock charts here in a little bit, but I just want to show you. BPI can be, in this case, a candlestick chart. But it can also be a point and figure chart. The charting type that you use, it's up to you. But because everything else that we use here at Sectors Made Simple is point and figure, and there's some very interesting things that we can get from point and figure charts, and I'll come to that later, this is what we're going to talk about today. So why do we calculate BPI? It's not just to give us another number to get confused with. BPI is going to give us a pretty decent indicator to estimate the risk of that given market. It is not perfect. No indicator is perfect. But because the BPI is defined, is only made up of companies on buy signals or sell signals, it is an indicator of the performance of that group, market, exchange, whatever it might be. So now we know what BPI is. But let's now ask, how is BPI calculated? Again, it's going to be a pretty easy one to explain, but it's one worth explaining. Step 1, go to a point and figure chart and find if that chart is on a buy signal or a sell signal. Let's go do this right now for a stock. This stock has had a very interesting past week for all that have been following NVIDIA. That is what we're looking at right now. I'll make it nice and big. So the first thing we need to do is find if we're on a buy or a sell signal. The way we do that is we start on the right side and we look at the current column and we see, is our current column above or below? So if it's O's in this case, is our current column of O's below the previous column of O's? These red O's means that that change happened today. So today we went on a sell signal. Specifically, this sell signal would be a triple bottom breakdown because you have your 1 bottom, your 2 bottom, and your 3 bottom. So triple bottom breakdown. And we'll see that confirmed right up here. Say today we went on a triple bottom breakdown. So in this case, NVIDIA would be on a sell signal. Because we're here to practice, let's change our end date to today. Maybe I made this a little too big. This is what the chart looked like. No, thank you. This is what the chart looked like yesterday. What signal were we in yesterday? Well, right now, we would be in a column of X's, a column of O's, but we are not below the previous column of O's. When we aren't in a current signal, we would look one column to the left. We would see, is this column above the previous column? So is this column of X's above the previous? Yes, it is. So in that case, we would be in a buy signal. So today, NVIDIA went from a buy signal to a sell signal. That might seem a little weird. It's in a buy signal until it's in a sell signal. But that's the way the point and figure works. It is in a buy until it's in a sell, which is one of the largest reasons why I say don't look at point and figure as, or I wouldn't recommend looking at point and figure as I buy this now or I sell this now. That buy signal could have been months ago. In some cases, for some charts, if the price really doesn't move much, years ago. There's a lot that goes into the significance, how important that buy or sell signal is, and we're not going to get into that today, because all we care about is one thing: buy or sell. So, as of today, NVIDIA is now in a sell signal. And that is that one chart. So again, we will always take the most recent signal as the one that we will use. Now, these charts go from left to right of how old the information is. So the stuff on the left is the oldest, or stuff on the left is the oldest, stuff on the right's the newest. So whenever we want to find the most recent signal, we start from the right and work our way to the left as needed. So this security that we see on, for the example, would be on a buy signal. So this is one company. We now do this for every company. If we were looking at technology, at semiconductors, or at hardware manufacturers, all right, we might do NVIDIA, we might do AMD, let's go do Intel, let's go do SOX, the semiconductor ETF. Let's add some technologies ETFs in there. So let's add XLK for a little bit of spice and everything nice. That is how you create your group of companies. One ticker at a time. Buy or sell. If it's in a buy, thumbs up. If it's in a sell, we note it and move on. So now we can actually calculate BPI. We've gone through our entire group. We know who's in a buy, who's in a sell, who's been naughty, and who's been nice. We now can calculate our BPI by taking the number of stocks or securities that are on a buy signal and dividing it by the number of stocks in that group. Let's use the S&P 500 as an example with some data that I pulled earlier today. There are 500 stocks, approximately 500 stocks in the S&P 500, and currently 206 of those are on a buy signal. So we do 206 divided by 500, and because BPI is a percent, we multiply it by 100. This would give us a BPI of 41.5%. 41.2%. If we go back over to stock charts and we go to BP SPX, we'll see that 41.2% right there. That is how BPI is calculated for one day. Now, how do we track it over time? And why should we track it over time? Again, it does not need to be point and figure that you track BPI with. Point and figure is really nice because it cuts out a lot of the noise, and all we get is ups and downs. So for our examples today, we're going to talk about point and figure, but remember that if point and figure isn't your style, you can use whatever charting method you like the most. Hello. My cat has this lovely trend of every single day she'll bring a little toy down and triumphantly say, "I killed it! I killed it!" I don't think it gets old for her, and it definitely does not get old for me. So thank you for delivering me the little toy. I'm glad that you killed that toy for about the 80th time in a row. Good job. Sorry. Now, we've tracked BPI because we now know where it's at today, but we need to do this every day so that we get those updating prices or those updating values. So let's chart it. Let's go and let's put our BPI on a chart. As I mentioned before, BPI is always going to be between 0 if everything's on a sell signal and 100% if everything is on a buy signal. Because point and figure uses boxes, we need a box size, and our box size, unlike a stock, which the box size is going to be usually somewhere around 1, our box size is going to be every 2%. For our columns of X's and our columns of O's, we're going to use the exact same reversals. 3-box reversals for X's and O's. So it's going to end up looking a little something like, that's pointing to the wrong place, this. You see 100 at the top, 0 at the bottom, and the BPI going up and down over time. There's a question here. The percentage goes from 0 to 100. Does that mean the higher the better? Great question. Not always. I'll get into that a little bit more in a little bit, but I'll give a very quick answer right now. When things are above 50%, it's a good sign because it means the majority of companies are on buy signals. But as things are constantly going up and up and up, things cannot go up forever. There's always pullback, there is always corrections, and there's this idea of the bigger they are, the harder they fall. If the BPI gets really high, it goes into a point called overbought, where there's a lot of people buying, so the minute there's a little bit of panic in the market, everyone's going to try and rush to get out the door, and things tend to drop. So is higher better? If all you care about is bullish or bearish, positive or negative, yes, higher is better. But if what you care about is risk, the higher the value, the more risk there is when a reversal does happen. Again, I got some cool little graphics to show later today to show this in a little bit more detail. So bear with me, but hopefully that answers your question. Speaking of bullish and bearish, positive and negative, glass half full, half empty. BPI gives us a way of gauging the attitude of the market by saying, is it bullish or bearish? Bullish. Think about a bull's horns. They go up. So someone that is a bullish investor or a bullish market is one where people think, or it is going up, positive price trend. And bears, a bear's claw swipes down. So think about it where it's going down. Investors or the market think or are going down, or a negative price trend. When we look at BPI, we can look at what the percent of BPI is to say whether or not the market attitude is bearish or bullish. A market is considered bullish when the BPI is above 50%, and it is considered bearish when the BPI falls below 50%. Now, as I said before, if all you care about is how excited are people, how optimistic are people, BPI is an interesting one to look at for that, because a bear market is not a bad market. To understand that a little bit more, I want to look beyond bullish and bearish and look at something called overbought and oversold markets. This is where BPI gets really interesting and really valuable. There we go. Just like we can use BPI to say if the market is bullish or bearish, we can use BPI to look at if the market is overbought or oversold. So let's again take our scale of 100 to 0 here. And overbought and oversold refers to the value of a market where it's saying, is it above or below what the fair value is? If that doesn't mean much to you, don't worry. This is the important part. A market is considered overbought when the BPI is above 70%, and a market is considered to be oversold when the BPI is below 30%. That's interesting. We just said that the higher the percents means that we're bullish. Yeah. But think about it like a rubber band. If you're stretching a rubber band, the further you stretch that rubber band, when you let go, the harder it's going to snap. So you let it go, you pull, snap. It snaps pretty hard compared to if it was just, you just let it go. The same thing happens here in both directions, where if we are overbought, that means that a lot of things and most things are on buy signals. And if a correction happens, again, investors and, well, not just investors, people panic. So when people panic, they're all going to want to make for the door, and they're going to drive the price down. When prices go down, sell signals happen. When sell signals happen, BPI goes down. Typically, not always, but typically when a BPI reverses above 70%, it drops pretty heavily. That's the reason why this overbought range, while a high BPI is a bullish sign, is also a warning, because it means that if things start to reverse, they have a lot of room to lose. Let's look at the other side of things. When the BPI is really, really, really low, not a lot of companies, maybe if it's 25%, 1 in 4 companies is on a buy signal. So when that price reverses, stocks start going on buy signals, everyone's going to want to get in. All right, people are starting to make money. I want to make money too. Do you want to make money? Let's make some money. Everyone's going to get in, and the BPI is going to take off. Stocks or securities are going to go on buy signals. The BPI is going to rise quickly. Before we go anywhere, wrong window. We'll come back to that. Let's go over here and let's look at what happens with our BPI. I will say this right now, and please remember this. This is not a 100% guarantee. If the BPI is above 70%, it's going to drop like a rock. If the BPI is below 30%, it's going to fly to the moon. Not always the case. But with that, let's go and look. Let's start off back here in 2020, March of 2020. The BPI went down to 2% for the S&P 500, back up to 16, down to about 12, and then flew up to 74. Went down to 46, up to 90, down again, up, down, up, down. The larger changes that we see typically happen above 70% or below 30%. The best examples I can give are what have happened recently in 2022 on the right side of this chart. We had a reversal at 76 down to 36. We had a reversal at 74 down to 38. We had a reversal at 70 down to 44. It's not perfect, but typically the higher the BPI, the larger a drop we will see. Not a science, but is a trend that has been observed over the market and applies to not just the S&P 500, but many groups as well. So that is the basics of BPI, and most importantly, why BPI matters and how we can use it. Well, actually, we haven't really gotten into how we can use it. So let's get into how we can use it, right? What good is information if you don't learn why it matters and how you can use it? So one of the ways that can be used is as a primary market indicator. As buyers, we want to invest in markets whose BPIs are rising, where we want to invest when things are going on buy signals. The majority of a stock's performance is due to its sector. So if the sector has companies going on buy signals, we want to be a little boat and get lifted by the tide. Again, a column of X's at 70% is a little bit of a red flag. A column of X's at 25% has a lot of room to grow. So when we're looking at BPI as an indicator of that market, the lower the BPI is while being in a column of X's, the better. And more importantly, when a BPI is below 30% and reverses into X's, that is a very important moment for that group. Now, I know what some of you are thinking. Why are we just looking at reversals? Why don't we look at buy and sell signals? Why don't we look at, is this current column of X's above the previous column of X's? Great question if you are asking that. If not, I'm going to give you the answer anyway. And the answer is because it's not appropriate. The reason that we have support and resistance barriers is because we are human. We think in support and resistance barriers. We think in changes in trends. When we see a price going up and up and up, we look to see, all right, the last time it made it to $46, it started going down. So when the stock starts getting closer to $46, everyone's sitting there and waiting. All right, is it going to go above $46 or is it going to reverse again? most point and figure chart signals, and not just point and figure, most chart signals are trends that we know not because it's common, because good luck or bad luck. It's how humans think. Not just how we think, but how we feel. We feel these support and resistance barriers in price. BPI is not a price. No one is sitting there looking at BPI as if it were dollars and cents. So because of that, there's not that mental pressure of this is a resistance barrier. There is a lot of meaning when that resistance barrier is broken. Instead, the valuable indicator for us is not the buy and the sell signals, it's the reversals. Did it reverse into X's or did it reverse into O's? And what percent did it reverse at? If it reverses into X's, the lower it reversed, the stronger the signal. The higher it reversed into O's, the stronger the signal. And this is never a guarantee. This is all just a matter of probability. It's increasing the probability or finding the probability that this event is going to happen. So again, coming back to what we've been talking about here, we can look at BPI and see when reversals happen. If we're just normal, not day traders, we're just normal investors. Most of the time, we're only concerned with buying long, so buying in the hopes that it goes up. So our valuable signal is when a column of O's reverses into a column of X's, and the strongest signals are given when the BPI is lower. So if we want to think about things as a football game, the overbought and oversold are close to the goal. Friendly goal and the other team's goal. So we can get offensive when we are under 30 because there's a lot of room for us to make plays. Then when we're getting close to the end zone on the other side of the field, we need to get defensive. We don't want to risk things. We just want to get those little plays to keep the ball moving forward. So offensive is probably going to be when the BPI is below 30% and reversing into X's. Defensive when it's above 70% in that column of X's because there's a lot of room to fall. And like I've indicated earlier, BPI is an amazing way to find how a market is performing. By looking at this one chart right here, we are looking at the performance of every single company in the S&P 500, not weighted by market cap. For those that might not be aware, the S&P 500, if you just Google SPY, this ETF is what's called market capitalization weighted. That means the bigger the company, the bigger the hippo. It matters more in that group. So the biggest company is also going to have the biggest say. So when Tesla the other day had a couple $1 billion wiped off of its valuation, the market suffered because of it. But BPI, the biggest company in the S&P and the smallest company in the S&P, all matter the same. One company, one part of our BPI. Now, I've shown you now the value of I've shown you how we can calculate BPI, why we calculate BPI, and a basic example of how we can use BPI. I've kind of shown you this, but I want to show this in a little bit more detail. Where can I find BPI? A free place to get BPI is the place that I've been showing us so far, stockcharts.com. On stock charts, if you go to Charts and Tools and you scroll down to Candle Glance, which lets you see multiple charts at once, you can find groups of the major bullish percent indices, which is going to be large exchanges and indexes. And by the way, this is the little cat that decided that she wants to bring me her toy. And sector bullish percent indices, different market sectors within the S&P 500. And note what I just said, inside the S&P 500. All of stock charts' BPIs are for the S&P, or their sector BPIs are for the S&P. The major bullish percent, of course, these aren't just going to be S&P. You can have the New York Stock Exchange, the NASDAQ, so on and so forth. There are many different options within this. For the sectors, those are only going to be limited to the S&P 500. But Sectors Made Simple also, as part of a subscription, offers BPIs. But our BPIs, again, I'm showing you where you can get S&P 500 BPIs for free. We're not going to charge you for S&P 500 BPIs. That's silly. Instead, we try and calculate something that Stock Charts doesn't. New York Stock Exchange BPIs. So why is it important that we have different BPIs? Well, it depends on what you're doing and how you're investing, and what your goals for investing are. I want to give two examples now. One of if you're investing within the S&P 500. Because if you're investing in the S&P, you're going to be more focused on the S&P. BPIs are going to be an amazing resource for if you're looking to get into a sector, be it if you're just buying the sector ETF, or if you're trying to buy a company within that sector of the S&P 500. It's great, and it's an amazing way to look at the entire sector in a single, balanced way. The biggest company and the smallest company matter the same for BPI. But it's not perfect. Some sectors, like technology, have more than 70 companies, while others have 20, 21, 22. When you have 20 companies in a sector, 2 companies changing signal, each one of those companies is 5% BPI. 2 companies changing buy and sell signals causes a reversal for that chart. It's very, very sensitive. And that's not a fault of BPI. That's just a fault of it's a very small size. There's this idea in statistics, the calculating probabilities and chances of things happening, that you only start to get significant information or significant data when you have a sample size of 30 or more. You have 30 things to look at or more. When you're looking at 20, that's not 30. So the significance of what that BPI gives you is lower. Because, again, 2 companies, let's say energy is doing extremely well, but BPI had an oil spill and ExxonMobil got caught in the crossfire. All of a sudden, our BPI is now reversed. Yes, energy is still going up. Most companies in energy are on buy signals, but because 2 companies reversed, we're now in a column of O's. So S&P 500 BPI has its uses and is very important, and that's the reason why I show you where you can find it. but it has its limits as well. So now, if you're investing outside of the S&P 500, our NYSE or New York Stock Exchange wide BPIs that we offer on Sectors Made Simple are going to give you a broader view. It's not 20 companies within specifically energy or communications are really small ones. It's not going to be, or utilities rather, not communications. It's not going to be 20. It's going to be 100, 200. Now that significance comes back. And we're not just looking at large cap companies. Remember, the S&P 500 is not the 500 largest, but 500 of the largest companies in the US market. What about the little guys? What about the guys that might not be little, but might not be big either? They matter too. So looking at the New York Stock Exchange, instead of 500, we now have over 3,800 companies. With over 3,800, you can be guaranteed that BPIs are much less likely to reverse because one or two companies had some bad press, some bad earnings, or decided to buy Twitter. And most importantly, and this is my favorite use of the NYSE BPIs, it gives us a point of comparison. Because if you have access to the S&P 500 BPIs and the New York Stock Exchange BPIs, you can compare them and see the differences. And again, you can use this comparison for anything, be it your primary indicator or a secondary indicator, to give you that idea of risk. If you're buying, for example, XLK, the S&P 500 ETF for technology, how much you invest or how much risk you allow might change depending on the BPI of that sector. If the BPI is very high, you might play it a little safer. If the BPI is very low and just reversed, you might want to hold and see it out. The choices are infinite. But while I still have a little bit of time, I want to go in now and look and compare the current S&P 500 BPIs with the New York Stock Exchange ones and show you just how much of a difference you can find when you're comparing the two. I've talked quite a bit today also about Sectors Made Simple. It's not just because it's a cool website. It is a service that we offer that provides an incredible amount of resources. We're not trying to tell you our place is the only place to find this information. Instead, we'll show you where you can find information, and we'll offer information that you can't find elsewhere, or will save you time. If you're interested to learn more about Sectors Made Simple, we have over 100 hours of webinars available on our YouTube. If you want some direction, you can visit our Learn site, learn.sectorsmadesimple.com, where we have all of our webinars available as well, all of our YouTube webinars available there, and many of them are organized into courses so that you can start and end one specific type of information. And if what we offer seems interesting to you, you can purchase a subscription through our website, sectorsmadesimple.com. And as an added bonus, starting next Wednesday, Julie Stav, who is my mother but is also in the chat with us right now, will be offering a day trading workshop so that you can learn not just how to buy long, but how to trade options, both puts and calls, taking long and short positions, utilizing technical indicators to invest, all in an interactive way with workshops, where you get to trade a fake money portfolio alongside Julie and all of the other classmates as you learn how day trading can be made simpler. So again, those classes are included in Sectors Made Simple subscriptions for new annual subscribers and all existing subscribers. If you need any help, you can always email us at support@sectorsmadesimple.com, and we're more than happy to help you out. So again, I want to wrap up today's webinar by comparing the S&P 500 BPIs to the New York Stock Exchange. Eddie, you do have to register for the day trading workshop. You should have received an email from us earlier this week with the link to register. However, if you didn't get it, just send me an email and I'll make sure that I can get that over to you. So let's go now and look. So we're going to start off here with discretionary, which is going to be consumer cyclical if you follow FinViz. Discretionary right now for the S&P 500 is at 28%, but is still in a column of X's at 40% for the New York Stock Exchange, a difference of 11% and direction. Technology we see is at 46% compared to 35%, another difference of 11%. Communications, this one is the one that's very interesting to me. Back to the question of the day, what sector am I looking at for growth in the coming weeks? Communications is the one that I'm interested in. There's some very interesting signals that we can be following related to price, but sticking to today's topic. Yesterday, the BPI was below 30%. So if we open up the chart, it was below 30% yesterday, is above 30% today, but is still in a column of O's. However, the S&P 500 BPI for communications is already starting to go up. So this is a sector that we're starting to see some moves in the short term for the S&P 500. And I'm hoping to see that growth begin here in communications as well. Techware, it's Marcos. Oh, hey, awesome to see you. Thank you so much for joining us, and I'm glad finals went really well for you. When you finish the homework, where do you send it? There's an email that I have created for the Spreadsheets Made Simpler courses. It's spreadsheetsmadesimpler@gmail.com. You can send your homeworks over to there. Come back. So unfortunately, we don't have too much more time, but in the charts that I've shown so far, we do see that there are some sizable differences between the New York Stock Exchange BPIs and the stock charts S&P 500 BPIs. And there's some very, very valuable insights that we can gain, such as we're starting to see some recovery here in communications for the S&P 500, while the New York Stock Exchange is just, lagging behind a little bit. But reversals below 30% are very important. And I actually will show this because we're not going too much further. The price is at a very interesting point. If it goes below $58, it's going to go on a sell signal. Where it goes from here, we are not sure. But the BPI shows that the S&P 500 is starting to recover for communications, is back into a column of X's below 30%. And the New York Stock Exchange is not too far behind. So this is one that I will continue to watch in the upcoming week, and is one that will be very interesting to follow in the near future, as we hope to see the market make a steady recovery. But I want to hear from all of you. What sector or what BPI is interesting to you to be following as the market hopefully bottoms out and we get to see where we can grow from here? That's all the time we have for today's webinar. Thank you all so much for joining us here at Sectors Made Simple. It's a pleasure to get to provide these webinars for you to help you invest simpler, no matter how you choose to invest. Again, for all those that are interested, Julie's upcoming workshop class series will be starting this upcoming Wednesday and is available for all current Sectors Made Simple subscribers and all new annual subscribers. If you're interested in a subscription, you can head over to our website, sectorsmadesimple.com, and purchase a subscription there. And if you have any questions or concerns, you can always email us at support@sectorsmadesimple.com. Thank you all so much. Have a great weekend, and we'll see you all very soon.